Welcome to part 3 of Learn Day Trading Strategies that Work in Today's Markets. This is Dr. Barry Burns with Top Dog Trading. And today we're going to talk about what I call the fractal energy or the energy of scale. Now, that is just a fancy term for talking about using multiple time frames. When I talk about multiple time frames, what I'm saying is we're looking at the same market. In this case, it's the stock Disney. But we'll have two charts up. Number one, we have the 2-minute chart there and the 6-minute chart over here. So looking at the same market from two different scales. Now, I like to use a 3-to-1 ratio. You can use a 4-to-1 ratio if you want, or even a 5-to-1 ratio. But 3-to-1, I like. It keeps those two synchronized and very timely, very tightly correlated. So that's my choice. Now, you can use a daily chart and a weekly chart. You can use a 5-minute chart and a 15-minute chart. If you want to use tick charts, you can use a 1,000 tick chart and a 3,000 tick chart. That's up to you. There's no magic to a 2-minute chart or a 6-minute chart. In fact, it's pretty fast. But anyway, that's the example for today. Okay, so let's talk about how it's traditionally done and why I don't follow the traditional method anymore. So the traditional approach is this, to say only trade your setups in the direction of trend on the longer term time frame. So let's look at what we're talking about here. So here's one of my typical setups, and we just call this a first retrace in the trend setup. So we've got a wave 1, and whoops, lost my little marker there. So we got a wave 1, 50 MA has started angling up, and we retrace back down to the 15 exponential moving average. We like to do that. That shows that the market hasn't come too deeply against the direction of the initial impulse move. We want strong moves up and then short moves down if we expect a continuation in the direction of the trend. Okay, so that's working out great. Then we've got a cycle low, and momentum is holding above the 0 line, so it's strong momentum. And then, not only that, that's actually acceleration, but to get momentum with it, we need an increase in volume, and we have all that. So, okay, that's the brief description of it being one of my setups. Oh, by the way, for support resistance, the 15 EMA also provides support resistance, and we've gotten to a new territory, which is yesterday's high. We're above yesterday's high. Okay, so everything looks great there. Now, even though that is a good setup that I often take, I will not take the trade unless it's confirmed by the longer term time frame or the bigger scale. And that, in this case, as I mentioned, is the 6-minute chart over here. So what we're looking to do, let's get that marker on there. There we go. So what we're doing is we're saying now, the traditional approach, again, is to say only trade in the direction of trend of the longer term time frame. That would be the 50 MA over here. And we do have that. We do have the 50 MA going up. So that's great. That's great. And that's fantastic. However, the reason that I don't use that anymore is because markets have changed a lot over the years. And trends don't sustain as much as they used to back in the days when the old classic technical analysis books were written. Back then, we didn't have as much computerized trading. I mean, there were computers, but your average person, your average retailer didn't have a home computer. And so they didn't have direct access. We didn't have high-frequency trading. A lot of the technology's just gone dramatically off the charts. So even though there was some computerized trading back then, it's not even close to what it was or what it is today. So that's caused choppier markets today. And now the other aspect of that is that trend is always a lagging indicator. Always a lagging indicator. By the way, the definition of the word trend, according to Webster's Dictionary, is to extend in a general direction. Very important to know that. There's two ramifications of that definition. Number one, it means that you cannot use a short-term indicator for trend. You cannot measure trend with a short-term indicator. Why? Because it goes against the definition of the word, to extend in a general direction. It is by definition a long-term measurement of the direction of the market. So to use any short-term moving averages or any kind of indicator doesn't measure trend, just doesn't. So that's number one. Number two, there's a financial reason, and that is we want to be trading in the long-term direction of the market so that we get a good risk-reward ratio. We want our losses to be small, obviously, and our winners to be big. So the way you do that is by using a long-term indicator to get in on a long-term move, therefore making your rewards long-term and bigger than your losses. Okay, so that's all great. And we use that on the shorter-term chart, the one where we're looking for setups. This time it's the 2-minute chart on the left. But for the confirmation chart, think about what I just said. We're using a longer-term chart 3 times slower, 6-minute versus 2-minute. And trend indicators are always lagging by definition. Therefore, why would you use a lagging indicator on an already 3 times slower chart to confirm a trade on that slower chart? It doesn't synchronize very well in a timely manner. And therefore, it doesn't give you a timely indication of entry. So we want to do the opposite. What we want to do is use a potential leading indicator. Now, nothing always leads the market, but a potentially leading indicator, as we've talked about before, and as I've demonstrated logically before, is momentum. So here's our momentum indicator, and we just want to make sure that momentum is angling in the direction of our trade, in this case, up. And it is a faster indicator, and therefore it helps to make up for the fact that this is a 3 times slower chart and synchronizes the signals to be more timely. So in this case, we have both, and that's great, but we'll look at an example where we don't have both. By the way, let me do this here real quick. Let me line up with the global crosshairs so you can see exactly where we would be entering. And we would enter on this bar right here. So because of the global crosshairs, you can see the vertical line on this 2-minute chart on the left. We've got the KD cross. We've got the MOM angling up. Over there, we've got volume angling up. We're bouncing off the support already. That's confirmed. Then on the longer-term chart, the 2-minute chart, you see that momentum down at the bottom is the green line that's angling up. And its moving average, which is the purple line or the magenta line, is also angling up. So it confirms the trade. Okay, let's look at an example where we have something a little different. All right, so now we're going to talk about a trend reversal trade. The average trend is 5 waves. And so over on the 2-minute chart on the left, you'll see that we have 7 waves. And that's an extended trend. That's when we can start looking for reversals. And we have a list of rules as to when we will take these reversal trades, but that's the first thing that we look at. Another one, notice that we've got big volume, so that also helps us. We've got cycle coming down. We've got momentum down over there. Now, look over at the 6-minute chart on the right. And there you will see we have, first of all, an engulfing candlestick pattern, so that's good. But trend is up, and yet we're looking to go short on the 2-minute chart. So this is a good example of how using trend to confirm the trade is not going to work very well, because even though sometimes it'll confirm a trade, it's a lagging indicator on an already 3 times slower chart. So you've got your cycle turning over already. We've got a really good cycle pattern, what I call one of my second chance cycle patterns there on the 6-minute chart. And then below that, in the third graph, we have MOM angling down, which is momentum, and that's a red. You can see it's got a 2 there as well. So basically, we've got the confirmation we need, which is not trend, but momentum on the next higher time frame. It reacts faster and therefore gives us more timely signals. So that's the way that works better in today's choppier, more fast action markets that are dominated by computerized trading. So if you like this video and you're watching this on YouTube, please click the thumbs up icon below and leave a comment telling me what you'd like me to cover in future videos or what you liked about this video. Also, I'm giving away one of my favorite trade strategies. I call it the rubber band trade. It has a really high win-loss ratio, and it's very simple. You can learn it in about 26 short minutes. So you can get that video explaining that trade strategy absolutely free by clicking on the image in the top left corner, or if you're on a mobile device, click on the little eye with a circle around it in the top right corner of this video. And once you do that, I'll personally email the video to you.